Mark Hebner, President of Index Fund Advisors, and welcome to IFA.TV, where our goal is to give you high-quality investor education so that you are far less likely to engage in speculation. As we like to say, replacing speculation with an education. And so I'd kind of like to explain how we look at these volatility events in the market and what it actually means for investors beyond the loss that you might have suffered in that particular day. So first of all, we like to say that the job of a free market is to set prices so investors will be rewarded for the risk they take. How do we do that? Well, we first rely on millions of traders around the world. We expect there are roughly 10 million traders around the world, half of them buyers, half of them sellers. It might not be exactly half, but somewhere in that ballpark. And they have equal and opposite opinions about what their particular trade will mean to them. The sellers think it's time to get out of an investment, or maybe they need their money. The buyers think it's a good time to get into the market and buy the security. So it's always a little confusing for investors to watch TV programs where they say everybody's selling or everybody's buying, because that cannot be the case. We don't get a change in price unless we have a willing buyer and a willing seller. So it takes at least two individuals to agree upon the trade and the price at which they're willing to trade. Now these individuals, 10 million of them, are watching all of the news, all of the information, and from that information they're making their forecasts, and all of that knowledge and wisdom and information gets embedded into the price at which they're willing to pay. So way back in the '08 crash, we came up with this diagram to help investors understand what's actually going on in the market. And what you can see here is this little teeter-totter, where on one side we have the news or the information, even the forecasts of investors that they might obtain from that information. The center of which we like to refer to is the uncertainty of the expected return of an investment. And when that uncertainty happens to be high, because we have a lot of bad news about capitalism, you could say, just in general, because we're referring to a global equity portfolio of some 13,000 stocks, which we like to call Capitalism Incorporated. Anyway, as we see bad news in the market, what ends up happening over here on the other side of this teeter-totter is the buyer, in essence, is telling the seller, in order for me to get my fair return, given the risk of this investment, I need to get a lower price than the price I was willing to pay when there was less uncertainty. But here's the thing you have to remember. Let's say we had 3 or 4 bad news items, interest rates and uncertainty about trade and whatever information that went in to increase our uncertainty. What that did is the buyers say, I need a lower price, and I need a price that positions me to get my fair return. So I don't know why someone would want to sell in that scenario, because it's already been priced for the positive expected return in the minds of roughly 5 million buyers who purchased that day. And by the way, every day, roughly 10 billion shares are traded around the world. So we have a very diversified set of securities that are purchased and a very diversified set of opinions, knowledge, and information of millions of traders around the world. And through that process, sometimes called the price discovery process, we get to the price that best positions the buyer to get the fair return for their investment. prices change as a inverse proportional reaction to market uncertainty, so that the expected return for the investment, call it the fair return, stays essentially constant over time. By the way, that's the expected return. If we think about the realized return, this is 30 days later, that's a very different number because there's a wide range of realized returns relative to the expected return. And that's one of the great lessons that you get from the Galton board. This is the stock market edition of the Galton board, is that even if all these beads start in the middle representing monthly expected returns, what investors actually realize, in this case over 600 months, is a wide range of actual returns. And people are trying to play this game where they're trying to forecast, in essence, where these beads will land in this distribution. And you would be far better off to accept the fact that it's virtually impossible for you to know where any particular bead will land in this channel. And these channels represent a wide range from roughly plus 15% a month to minus 15% a month, with an average down the middle around 1%. So there's several lessons for you to think about relative to market volatility. And the best thing for you to do is just ignore it and sit tight in your investments. Thanks for listening.